Silver didn't just fall, it was dumped nearly 30% in a shockingly short window. For many retail investors, the drop didn't feel gradual or logical. It felt sudden, violent, and unforgiving. One moment, silver looked volatile but manageable. The next moment, screens were flashing, red positions were liquidated, and stop losses failed to protect anyone. For people who were long silver, especially with leverage, this wasn't just a bad day. It felt like the ground disappeared under their feet before they even realized they were standing on it. By the end of this video, you'll understand exactly how this kind of silver collapse happens, why retail investors are the ones who consistently get crushed when it does, and what you need to watch next so you don't walk straight into the same trap again. This isn't about hype panic or blaming the market. It's about understanding the structure behind silver, because once you see the structure clearly, these moves stop feeling random. To understand what just happened, we need to rewind the timeline and look at what moved first. Price is never the first thing that breaks. Before silver dumped, pressure was already building beneath the surface. The dollar was strengthening, liquidity across markets was tightening, and volatility was rising quietly. None of this looks dramatic if you're only watching a silver chart, but inside the paper market, stress was accumulating. When price finally reacted, it didn't drift lower slowly. It snapped. That snap is important because it tells us this wasn't normal selling, it was forced, selling triggered by structural pressure releasing all at once. Silver is one of the most leveraged major markets in the world, and leverage is the first reason these collapses become so violent. Think of silver like a glass elevator in a skyscraper. On the way up, it feels incredible because it moves faster than almost anything else. Small gains feel huge, confidence builds quickly. But when something goes wrong, there's no shock absorber. Even a modest downward move becomes dangerous because leverage magnifies every tick. When silver starts falling fast, margin calls don't wait for emotions to catch up. They trigger automatically. Selling begins not because traders decide to sell, but because they are forced to. That's how a pullback turns into a dump. The second reason is margin pressure, and this is where COMEX becomes central to the story. Margin requirements are not fixed. They rise when volatility rises. Imagine standing in a room where water is slowly filling from the floor upward. At first you're fine, then it reaches your knees, then your chest. Eventually you either climb out or you drown. Retail traders don't have unlimited capital. When margins rise quickly, most cannot meet the new requirements. They're forced to liquidate positions at the worst possible moment, adding fuel to the sell-off. This isn't about opinion or conspiracy, it's mechanical. The third reason is liquidity evaporation. When too many traders rush for the exit at the same time, liquidity disappears. Picture a crowded theater with one narrow door. The first few people get out calmly. Everyone else panics, pushes, and chaos takes over. That's what happens during a silver dump. Bid-ask spreads, widen price gaps, lower and stop losses. Don't protect you, they accelerate the fall. This is how silver can lose 30% before most traders even understand what's happening. The market isn't punishing belief, it's punishing leverage and poor positioning. Now let's look at the data that confirms this wasn't just emotional selling. During the dump, open interest collapsed sharply. That tells us positions weren't merely losing value, they were being forcibly closed. At the same time, margin stress increased, which historically aligns with sharp silver declines. Then there's the paper to physical imbalance. Hundreds of paper ounces trade for every ounce of real silver. When stress hits, paper markets react violently because they are built on leverage and promises. Physical markets move far more slowly. These metrics consistently flash warning signs before headlines ever do. This playbook is not new. In 1980, silver surged as retail investors piled in and leverage exploded. When margin rules tightened, price collapsed, and countless traders were wiped out in days. The lesson wasn't simply that silver crashed. The lesson was that leverage turned confidence into catastrophe. The same structure appeared again in 2011. Silver raced toward $50 enthusiasm. Peaked margins rose, forced selling kicked in, and price collapsed more than 50% over the following months. Different decade, same mechanics, same outcome. History doesn't repeat perfectly, but in silver it rhymes loudly. So what happens next? There are only a few realistic paths from here. Silver could stage a sharp relief rally as selling pressure temporarily exhausts itself. This often pulls retail back in too early, especially if the bounce feels aggressive. That rally fails if volume remains weak or if margin pressure returns. Another possibility is extended sideways chop, where silver moves violently without a clear trend. This grinds traders down, psychologically replacing panic with boredom until participation fades. The third scenario is deeper structural stress where paper markets remain unstable, while physical demand holds widening the gap between the two. That scenario only fails if confidence in the paper market is restored quickly. What matters now isn't prediction, it's preparation. Watch margin changes instead of obsessing over candles. Watch open interest instead of headlines. Pay attention to dollar strength and liquidity conditions because silver reacts violently when liquidity dries up. Understand the difference between physical ownership and paper exposure. Physical silver doesn't get margin called, paper silver does. And never confuse conviction with leverage. Many investors believe in silver's long-term story but still lose because they take short-term risks they cannot survive. Right now, there are three types of people watching this. The first is panicking, reacting emotionally to every price movement. The second is frozen, overwhelmed by noise and uncertainty. The third is learning, understanding the system, respecting volatility, and refusing to become exit liquidity. Only one of these groups consistently survives markets like silver. So be honest with yourself. After this 30% dump, which one are you becoming? Drop your thoughts in the comments. Was this silver collapse manipulation, or simply how leveraged systems work? If this breakdown helped you understand what really happened, share it with someone who's confused right now. And if you want clarity instead of hype as this story continues to unfold, stay connected, because in silver markets, the real trap isn't the price. It's not understanding the system behind it,